talk about who's going to be guiding us today. Our speakers from LexisNexis Risk Solutions today are Chris Owens and Dan Polar. Chris is a Senior Director of Financial Crime Compliance, has more than 20 years of experience in BSA, AML, and OFAC, and other risk regulations. Daniel's Director of Financial Crime Compliance and is responsible for defining strategies in the US and Canada that deliver innovative compliance technology combined with comprehensive financial intelligence. Chris and Dan are joined by Joseph Cataldo and Bishi Nayak of Psionic. Joseph is a managing partner at Psionic. He assists clients to help them tailor, implement, and remediate AML solutions for their KYC and CIP programs and due diligence. Bishi drives strategic initiatives focused on enterprise risk management, AML, and operational risks. These gentlemen will provide an overview of the AML objectives, which include streamlining AML, counterfinancing of terror laws, and also kind of the interplay and coordination between government and industry that's going to encourage adoption of these risk-based AML programs and the nuances therein. So Dan, enough of me. We want to get to the real thought leaders. I'll turn it over to you.
Thank you so much, Brian. Hello, everyone. It's great to be with you today. In this section, we'll discuss some of the key requirements of the Corporate Transparency Act. The Corporate Transparency Act mandates that FinCEN establish a centralized national registry of beneficial ownership information. And really, this is a result of the last status mutual evaluation and is designed to end anonymous shell companies, which criminals have historically used to hide illicit funds. Individuals who have substantial control over the entity, such as the president or CEO, or those with at least 25% ownership, will be required to register their name, address, date of birth, and ID number, such as a driver's license or passport number. So how will this affect existing entities and new entities? So entities in existence before the effective date of the regulations will be required to report their beneficial ownership information within 2 years. And entities formed after the regulations are effective will be required to file their beneficial ownership information at the time their new entity is formed. Just want to make sure. Yeah, okay. So the beneficial ownership registry excludes several types of reporting companies, which we've noted on this slide, including securities issuers, entities already required to disclose beneficial ownership, foreign exchange dealers, public accounting firms, pooled investments, and others that we've noted here. These entities are governed by other regulations. So as I've mentioned, FinCEN will establish, implement, and maintain the beneficial ownership registry. There will be limits on the use of the beneficial ownership registry, which we've outlined on this slide. And any breach of these use cases will result in civil and criminal penalties. I also wanted to point out that FinCEN's registry will minimize the impact at the individual state level, since each state will not be required to maintain a similar beneficial ownership database. So really the onus will be on the entity to ensure they're filing the appropriate documentation with FinCEN in a timely manner. And Chris, from a timing perspective, do we have any insight into when these rules may take effect?
We sure do, Dan, but I think really that question is about what's the process for a law to become reality. So everybody's pretty familiar with what it takes for a bill to become a law. It takes years. A lot of the provisions within the AML Act have been languishing in Congress in various forms for a good 3 to 4 years on some topics. But now that the law has been passed and enacted, we're really looking at a multi-year process to get from where we are today to the proposed regulations. There's a variety of milestones in the law. What I've got on the slide here today really focuses on beneficial ownership, but it's really applicable to the AML Act in totality. So new regulations have to be proposed either at a 6-month milestone from January of this year or a 12-month milestone. And there's a variety of studies and some adjustments to certain elements of the Act and the proposed rules, even after the 12-month milestones. And so once those rules are proposed, there's a comment period. It comes back. There may be modifications to the originally proposed rules to incorporate that feedback, and then they'll finalize those rules and make those regulations effective, and that effective date is sometime after the date that the final rule is actually put into the Federal Register. And so with that, we're still looking at 2 years out, right, before we have anything that's concrete, finalized in the Federal Register and with an effective date. And those effective dates can range from months to years between the final rule being effective, in the register, and in the time that financial institutions actually have to demonstrate compliance with those new regulations. And so the reality is, for beneficial ownership specifically, we're 2024, 2025 before we have any meaningful beneficial owner registry in place, accessible, populated with anything, and people actually using it for operational benefit in law enforcement investigations. And I think the reality is this cadence is generally prevalent across most of the provisions of the AML Act, whether they apply to financial institutions or whether they apply to FinCEN and other government agencies themselves. Bishi, do you have some thoughts on kind of the international experience around beneficial owner registries outside of the U.S.? I think there's some precedent here for the duration of time, taking our cue from others.
Sure, Chris. It's a complicated process. Even if the regulators finalize the rulemaking process, by the time they're putting the infrastructure and the whole reporting mechanism, that's going to take some time. If you just look at on the Europe side, this requirement was introduced as part of the AML 4th directive. This is kind of reinforced as part of the AML 5th directive also. Now, after a few years of that, if you look at the European Union, out of the 27 countries we have, probably more than 50% of them are actually behind schedule. In fact, very few, I would say probably 5 or 6 of them are actually operating the desired way in today's time. So I agree with you, it's going to take some time. We are not talking of weeks here. By the time we have the whole reporting mechanism and the rulemaking, all those things are completed, we are talking of months here, definitely not weeks.
Okay, so this is Joe Cataldo speaking, just so that everyone knows the voice from Psionic Advisors. I just wanted to quickly summarize some of these key points, and then we'll move on to the next topic in our agenda. So to summarize everything that Dan, Chris, and Bishi have said, there really is no change to the existing CDD rule and requirements. And in fact, the law makes that explicit. You can see the language on the law on your screens right now. The other thing to make very clear is that a reporting entity is not a financial institution or bank, right? The reporting entities are not most of you who are on the call right now as AML officers and analysts in financial institutions. So the requirement is not being placed upon you. Really, if you look at it, the only longer-term impact that we can foresee is that the financial institutions may be able to use the beneficial ownership registry for the CDD processing that it does. And this is only if the reporting entity gives you permission. So that really is the only key kind of major change that could be coming on the horizon. And a lot of these details, as Chris said, are very, very nebulous and in fact just don't exist. We don't even have a notice of advanced rulemaking from FinCEN that contemplates any of these details. And in fact, there was an article in the Wall Street Journal on March 2nd where Kenneth Blanco, the head of FinCEN, was interviewed, and they pressed him at the Wall Street Journal on details around how this beneficial ownership registry will function. And he was decidedly not going to give any details. One of the things he did say in his statements is that banks should not be looking at this as, oh no, not more regulations, that the goal of the Act itself is to simplify, streamline, and make more effective. And that is the theme of the next section of our presentation. So I'll advance the slides. So risk-based AML and CFT programs. One of the key goals of the Act has been to reaffirm, make explicit in the law, and codify in the law a risk-based approach. That's something that's been a de facto standard for all of us for over a decade now. And so I should say that the source for this information that you're going to see in the next few slides is the Act itself, but also the advanced notice of public rulemaking that was published by FinCEN in September of 2020. The comments were due back in November of 2020. And so you'll notice then, therefore, that the law came out after the AP rulemaking came out. So this was not something that was done kind of in isolation. The question is, this is part of one tapestry of rulemaking that FinCEN is publishing and the law itself. The other thing, before I advance the slides, just to notice is in the FinCEN proposed rulemaking, FinCEN goes through a nice kind of detail, almost 4 to 5 pages in the rulemaking around the history of how a risk-based approach has become the way that all of us do business on a day-to-day basis. It starts with the whole history of the BSA Act in 1970, which was very, very prescriptive, through the evolution and kind of recognition that, you know, there really one-size-does-not-fit-all mentality kind of became a recognition across the industry that a retail bank is not a correspondent bank, a private wealth firm is not a corporate bank, and so the controls, the approach should be different. And the idea is here that the Act is trying to clarify and formalize that de facto standard that we've all been operating under for, again, more than a decade. So the first content of the law that I wanted to highlight for everybody is improved clarity around what is reasonably designed. So there was this ambiguity. Is reasonably designed to comply with the Act, or is reasonably designed to detect money laundering and criminal activity and financing of terrorism? And the new Act now makes very clear that the higher bar is the expectation from a regulatory standpoint. That is, reasonably designed means designed to detect and prevent criminal activity. And I guess at this point, maybe just a personal note, most of us, in fact, I think all of us, are passionate about our jobs. We do this to help fight financial crime. We are helping law enforcement stop truly bad actors from doing truly malicious things. We're trying to make the world a better place. And this change kind of speaks to me personally because we're not here to check the boxes. We're here actually to make a difference. And this is something that I think is really, clear in the Act itself. And actually, again, if you look at the statements from Kenneth Blanco from FinCEN on March 2nd, this is something that's a theme that runs through every slide that we're going through on today's presentation. Dan, I think you had some thoughts on this as well.
Yeah, thank you, Joe. I just want to say I echo everything that you just mentioned. As a practitioner, I was involved with setting up the CIP program for a super regional bank for Section 326 of the USA Patriot Act in October of 2003. At the time, my number one concern was protecting our brand name from being implicated with terrorist financing. I mean, obviously our mission was to comply, but it was really to ensure the tragic events of 9/11 didn't happen again. So I'm right with you with your statements on this slide.
Yeah, thanks, Dan. So the next thing I'll highlight in the law is, again, another definitional concept that was always ambiguous, and they've tried to make it more clear in the Act, and that is, what is risk-based? Now, if you look at the language in the law, and I haven't put everything here on the slide, there's nothing that you're going to read that is new or shocking, or I think if anyone on this call was asked, can you define what is a risk-based program, you would have very similar language to what you find in the law. The one thing that I will highlight is if you look at the very end of that quotation that I put on the slide, you'll see the language rather than low risk. The law here is acknowledging that you will be able to reallocate resources. And this is something that is new. This is explicit, and this is in the law, and you'll see now that the FinCEN rulemaking is going to echo this, right? So this, I think, is a change that I think is a very positive change. And again, it gets back to this theme that's running through our conversation today, which is effectiveness. So the next thing that I want to highlight, and this is something that is of, in some places, great concern, and in some places, no issue at all, which is the idea of reshoring your AML CFT program. This language here is that the AML CFT program must remain performed by persons in the United States. Now, if that's shocking language to you, if you haven't seen that yet, I should note a couple of things, right? First, this was added late in the bill's evolution. and it's not clear what Congress's intent was. And the other thing is that with all of the advanced rulemaking that has come out through the evolution of the bill into a law from FinCEN, FinCEN has been completely silent about any need to reshore your AML CFT programs. So this is something I would say you should keep an eye on it, but it's not something to panic about. We have to find out what Congress intended here. One other maybe point just to point out, if you look at, and that's the reason I put the quote remain, that word is in the bill again, and remain kind of implies that there isn't a change. So that's kind of, if you do have an offshore program or partly offshore program, that's something that people are pinning a lot of hopes onto that language there, and maybe there wasn't an intent to change things. So finally, on the right side of the slide, the bill contemplates new functions within Treasury. And the idea here is to, again, improve coordination between law enforcement, the Treasury Department, and financial institutions and the regulators, and to reset and set very clear risk-based priorities by Treasury. Again, this is back to effectiveness, right? That we are all now becoming much more in tune with what is Treasury trying to accomplish through all of these programs. And the final thing is a set of charters for Treasury to look at the SAR and CTR filing guidelines and re-engineer them. And Bishi is going to be speaking next and going to give you some more detail about what to expect there. So that is what is in the law. Now I'll just make a couple of comments about what is in the rulemaking that was published by FinCEN in September. Basically, it echoes the priorities and content of the law. So you see now it defines in the rulemaking what is an effective program. And again, I'll say the same thing I said before, which is if I asked anyone on this call, what would you think is an effective program, you would come up with very, very similar language. The other thing that it does is makes explicit the need for a risk assessment. Again, this is something that has become a de facto standard across the industry for most, large to mid-sized institutions. So unfortunately now, for those of you who haven't been doing this, this is something that you're now going to have to contemplate doing on a regular basis. That, you have to have an explicit, now there's an explicit requirement proposed now in the advanced rulemaking, which obviously hasn't been published yet, so it's not in effect yet. But it's time to start thinking about it, if you're not doing it, to do a regular risk assessment of your program. The other thing on the upper right that it, again, echoes the law is it makes explicit that the financial institution should take into account Treasury's priorities. So in the law, it's saying the Treasury shall publish strategic priorities. In the rulemaking now, FinCEN is saying you shall take those priorities into account when you're defining and executing an effective program. And again, it echoes this language that I think is a positive change for all of us. It acknowledges that an effective program may mean that you reallocate resources from lower to higher priority and higher effectiveness tasks. So that is a little bit about the risk-based programs. And now I will, now there's a question. So Brian, you want to talk everyone through that question?
Absolutely. So everyone, are your AML operations impacted if the rulemaking requires onshoring? So everyone just kind of click on that and we'll see what everyone has to say. Give everyone a few minutes. Oh, go ahead. What was that?
Yeah, no, I was going to say there was a question about reshoring. What does reshoring mean? So reshoring means basically if you have folks within your AML CFT program that are not domiciled in the United States, that there is concern that the language of the law may require that you bring those folks back into the United States. What I'll say again is, just to repeat what I said before, this is not something that is clear. The law is not clear about what the expectation is, and so I don't think that, no one from Psionic is recommending that anyone begin the work of reshoring. I think what we should all be doing is keeping an eye on things.
I absolutely agree with you. So let's see. So luckily everyone here says nearly 42% say no, so that's good. But I think this is a really interesting question just for the sheer logistics of all of that. If you would have to do it, it would be quite a heavy lift. So good question.
Okay, over to you, Bishi.
Thank you, Joe. Let's talk about the regulatory reporting, which, as Joe mentioned in the initial discussion, is kind of one of the key pillars of the AML Act 2020. So as all of us know, regulatory reporting takes a significant amount of effort on the overall AML program, right? In fact, FinCEN survey has shown on firm on average spends around 28% their cost just for the regulatory reporting compared to the overall AML program they have. Now, if we look at historically, there have been three major concerns around the regulatory reports. One being the transparency. Now, considering the regulatory reports are the bondage between the financial institutions and the law enforcement agencies, there is absolutely no transparency to the financial institution in terms of what the information has been shared, right? They don't know whether the SAR was good or bad, or what was useful versus what was not useful. Those kind of transparency is not there for the financial institutions. Second, the nature of information. Now, of course, all this reporting process has been decades old. So obviously, a lot of things have changed over the period of time. The business process has evolved. So there is always a question comes up, do they need to kind of revisit this whole process and, make necessary adjustments? And third is the thresholds. Now, the suspicious activity report, which is the SAR, has a threshold of $5,000, and that was put in place back in 1996. If we talk about the currency transaction report, the CTR, we have the threshold of $10,000 put in place back in 1970. So if you do a simple, inflation-based adjustment of $10,000 in 1970, it comes out to be more than $60,000 in today's world. So obviously, these are what the fundamental concerns we had with the regulatory reports. Now let's look at the AML Act 2020 and what it tries to address, or what it's trying to do on these specific concerns. If we look at the AML Act 2020, in fact, these are the ones or the primary points they're trying to address as part of this whole act process. Now, if you look at the transparency, that the clear guidelines for the regulators to provide feedback on a semi-annual basis to the financial institutions on the effectiveness, the trending, as well as the typology-based information. They would require the financial institutions, obviously to make adjustments or whatever based on the information that they're going to get from the regulators. But the regulators are expected to provide on a semi-annual basis, the feedback to the financial institutions. Now, if we talk about the nature of information, now obviously the rule requires, as part of the modernization process, it requires the regulators to review the reporting process and make necessary adjustment as it's required to be. Now, if we talk about the thresholds, in fact, the AML Act 2020 actually has a clear lines being mentioned in the report where it requires the regulators to review the thresholds and then make necessary modifications. Now, there is a thought process that if the currency transaction report, if they increase the threshold from $10,000 to $20,000, FinCEN is expecting a 65% drop in the number of CTRS that's been reported by the financial institutions. Similarly, if the SAR threshold increased from $5,000 to $10,000, they're expecting a 21% drop on the number of SARs being filed by the financial institutions. So obviously, it's kind of a positive news for many of the financial institutions, but obviously there is a pushback from the law enforcement agencies because they fear the risk of losing the granularity or losing the details of the information that they're receiving today. So we have to see, as I think Chris mentioned, as well as Joe mentioned, 2021 probably is the year of rulemaking. So we have to see how the rulemaking actually is going to take in shape. But definitely we are expecting some changes around the regulatory reporting in line with what we see on this AML Act 2020.
So Bishi, other than the amounts, the transaction amounts, do you expect some differences in approach between the CTR and the SAR filing requirements in terms of the changes that are coming?
Sure. I think, the regulators know which are the kind of the bigger pain areas versus, which are the kind of the less pain areas for the financial institution. In fact, again, FinCEN's survey has shown an overall, if you look at the regulatory reporting framework for the financial institutions, 90% of the load is actually in the SARS side, where the 10% is actually goes to the, the remaining report, whether CTR or any other kind of regulatory reports. In fact, again, it of course, again, varies from institution to institution depending on the size and the, the operations and all. But the survey has shown that on an average, the financial institutions spend around $10 for a CTR, but a cost of a SAR is actually more than $1,000 for the financial institutions. So there is a thought process that they may want to simplify the whole CTR process, just keep it to, a $10,000 transaction just for one transaction, and any kind of aggregations or any kind of further, complexity will be put behind on the SAR side. So again, we have to see how the rulemaking is happening and what kind of the actual rule process is happening in the coming months. But as to answer your questions, definitely we are going to see changes on both sides. Whether it will be same change or different change, we have to kind of wait and watch for that. In fact, we already see some of the things have already started. I think there is a recent guideline came up, I think maybe last week on FinCEN in terms of the whole SAR reporting around the antiques dealer as well as the art dealer and all. And I think Chris, Chris or Dan, I think you have some thoughts around that as well as, I'm sure you have gone through the recent publication from FinCEN as well.
Yeah, thank you, Bishi. Yes, there's some breaking news on this topic. FinCEN issued a notice on Tuesday of this week related to trade in antiquities and art, along with SAR filing requirements related to these topics. The notice contained instructions on the SAR narrative, including the sentence which I pulled directly from the notice, which says filers should provide all available details, such as names, identifiers, and contact information, including internet protocol and email addresses and phone numbers. So, Chris, do you have any thoughts on that?
I do. If I'm kind of sitting on the other side of the desk, Dan, and I'm an AML investigations team or a BSA officer, I'm sitting there thinking, oh my gosh, I've got a whole other thing I've got to contend with, arts and antiquities. Now I need to kind of pay attention. But the worst, I'm sitting there going, okay, do I have email? Do I have phone number? Do I have internet protocol addresses? And so where do I get this? It's not coming through my transaction monitoring system. I'm getting alerts on transactions. I'm doing investigations, but now there's this other thing, right? And the reality is, most people already have this content and data readily available within their organizations. And I'll just use our experience as an example. So we've got a cybersecurity team, we've got a fraud team, and then we've got, kind of OFAC and other sanctions compliance on a global basis. And, connecting the dots on those is sometimes a challenge. But really what we're talking about is most institutions probably have a fraud tool that does IP blocking. Most institutions have, a cybersecurity team or somebody managing infrastructure that are looking at, hacking attempts or penetration attempts. And so a lot of this data is already there. And so when you kind of go talk to your fraud partners or cybersecurity partners and say, hey, what do you have? What you'll find is it's really quite easy, albeit with some help from technology. It's often quite easy to be able to integrate these tool sets. And so like ThreatMetrix is a great example. We use our own tool to identify, potential information security breaches or penetrations. We also then have this content around email and telephone and IP addresses that we can actually go in and look and pull this information together. So this can easily be automated and integrated into a workflow so that it's giving the investigators the network analysis they need on an automated basis to help them populate these SAR narratives and do that investigation. So it can seem a little onerous and disconnected, but really I don't think it's as difficult to accomplish as I would normally have my knee-jerk reaction as an operations leader.
So Chris, I appreciate that. I think I would probably just say that I think that's a great example of AML, cyber, and fraud converging. And it's not necessarily the organizational structures themselves coming together. It's really leveraging the common data sets. That's the key here.
Exactly. Joe, did you have something to add to that?
No, I think you guys did a good job summarizing.
Fantastic.
Thank you. Thanks, Chris and Dan, for the comment. So let's talk about some of the other things that the AML Act 2020 actually is trying to cover as part of the regulatory reports, right? So one of the other things they are talking about how the information, the guidelines around the information sharing, right? Specifically, this is a complicated process, right? And specifically, if you're in a global institutions, have offices all over different countries in the world, this is kind of a tricky issue. And this is, of course, a sensitive issue as well as a complicated issue, right? Because we have so many different countries, they have their different laws, jurisdiction-based laws, as well as we have the PII-based information. So it's kind of a complicated process and often confuses or creates confusion in terms of what information can be shared, what cannot be shared, and all, right? So the AML Act 2020 actually lays out the guidelines for the financial institutions, or in fact the regulators, to come up with a clear guidelines around that. In fact, they have given a time frame that by next year, which is this year, by 2021, they have to go back and provide the feedback to the Congress in terms of what are the steps they are going to do, and they need to provide this whole thing, the roadmap in 3 years time frame. And now there is a thought process that the foreign branches who are operating in the U.S., probably they will be allowed to share the information to the head office, whereas any U.S.-based institutions, if they have offices in foreign locations, they would have some kind of restrictions, right? Specifically, if they have branches in countries like Russia or China or any of those countries which are labeled as, the so-called state-sponsored terrorists, they would not be allowed to share the information if they have branches in those countries. Now, if we talk about the other component that the AML Act 2020 actually talks about, is around the virtual currencies. As all of us know, this has become the new phenomenon. Pretty much all of us are dealing with this or at least hearing about this on a day-to-day basis. Whether we talk about the virtual currencies, the bitcoins, this is kind of the new day-to-day phenomenon in the industry. Now, obviously, the law actually requires the regulators to finalize the rules around the whole virtual currency and digital wallets as well. Now, most likely all those things would be considered as very similar to the cash transactions. So your record retention requirement or any kind of reporting requirement that we have for the cash transactions will be applicable to the virtual currency or the digital currency or the bitcoins and all. So that's again, we have to wait in terms of how the rulemaking and the details of the rulemaking, which is going to come out, in next few months. But obviously, these are kind of very clear guidelines that have been laid out as part of the AML Act 2020. So in fact, they have tried to address the pain areas around the regulatory reports, what has been going on for the last few years, and the Act actually defines or lays out a framework in terms of addressing those fundamental concerns. Now, we have to see how the final rulemaking is happening and what are the guidelines that FinCEN is going to publish in 2021. But definitely we can expect, considering the importance as well as the gravity of regulatory reports that has been laid out in the AML Act 2020, we can definitely expect some changes around in this area. One of the other key component, I think, in the AML Act 2020 talks about the model risk management. Dan, I think you have some good observations and good thoughts around that as well. Okay?
Yes, thank you, Bishi. We'd like to spend some time discussing the impact the AML Act will have on model risk management. And we'll break this down into some questions that we think you'll find helpful. So what does this mean? The AML Act will codify requirements for development, implementation, and use of compliance technology, which includes machine learning and artificial intelligence. We'll have this outlined on the next couple of slides. I know that I hear a lot about machine learning and AI in the industry today, so these requirements will be really important for everyone to understand. Much of the law focuses on things that we could miss or fail to adequately challenge during testing and implementation. This is especially true since a lot of these new technologies will result in cost savings to your organization. So Chris, I would say we have a lot of bankers on the call with us today. Many of these folks may have already passed examinations related to these systems and processes in the past. And I'd like to think that none of what's noted here is difficult, but it's also not magic. It will require adequate planning, evaluation, and end-to-end operational risk execution. Could you provide some thoughts on how these requirements will impact the bankers on with us today?
Yeah, I think that's a good question, Dan. And the reality is I think it's going to impact everybody a little differently depending on the size, complexity of their institution and where they're domiciled. So large, complex banking organizations, the top tier banks have been, applying the model risk management standards published back in 2011 to their AML programs for some time. It's been a point of contention, I think, between the banks and the regulatory examination teams for a number of years because it wasn't originally intended to be applied that way. And then as you kind of go down the bank size scale, kind of schema there, I think it becomes a little different. If you've been in New York, you're subject to the New York DFS Rule 504, and so this legislation here at the federal level is highly likely to mirror the New York DFS Rule 504 in some respects, as well as integrate some additional components out of the supervisory guidance on model risk management that's in the market today. So I think, one, it's not magic. Two, the impact is going to depend on the size and location of your organization. Now, that said, I think based on our own experience with our customers using different AML software and data services, I think there's a lot of work to be done. And that work really goes back to kind of taking a hard look at the guidance that's out there, taking a look at Rule 504, and evaluating how do you develop, test, and implement technology in your compliance program or machine learning or AI type models. Because what we often find, what comes across our support desk is things present oftentimes as, well, I'm not catching what I want to catch. And then we start talking about the internal control framework that's implicit in the regulatory guidance. And oftentimes out of 9 or 10 kind of standard control sets that we would expect to see, less than half actually exist, either in the implementation or even the ongoing management. So I think there's some work to do, but it really isn't magic, and it's really not difficult. It's just time-consuming and takes a concerted, deliberate effort to kind of pay attention to it, so to speak.
Okay, thank you, Chris. I have another scenario I'd like to pose to you here. So as a practitioner and vendor over the years, I've seen scenarios where a new compliance team may inherit an existing screening compliance process. The new team may not ask adequate questions about how the system or processes work, or even if the results are effective. What impact do you think these requirements, Chris, would have on that scenario?
Absolutely. And of course, Playbook 101 for a new AML leader is always get an independent assessment, right? Come in, where are my consultants? Who's coming in? Who's going to do? Joe's going to love this talk track, by the way. Who's going to do this independent evaluation? Because inevitably, you get a little bit of groupthink that happens as you go through a program build and you're maintaining a program, and there's a certain cultural and risk appetite applied. And as a new leader coming in, I want to know, okay, if I look at this through the same lens I've always looked at, I know there's blind spots. There always are. We're human, right? And so I always want to get somebody in there. I want to talk to my auditors. I want to talk to my examiners. And I may want to have somebody come in and do a full program review, particularly around my technology implementation. If I was to look at the control framework around my my models and my compliance technology and the algorithms I've got in transaction monitoring and sanction screening. I want somebody to do a deep dive. Just at a basic level, do I have a control framework in place that I would expect as the new owner of this program? And then start working from there. That's generally how I approached it when I've gone in, either as a remediation or as a new person. You know, what am I inheriting here, and how do I make that assessment? And usually I rely on people like Joe or others to kind of come in with that broader perspective. What are we seeing across 50 or 100 or 1,000 customers? I want to know where I stand against that benchmark.
So, Chris, I would probably just come back with you and ask, how can bankers with limited compliance staff and limited technology resources handle what you described, but especially during the COVID pandemic?
Yeah, it's a great question. I think two things. That assessment is really, I think a lot of us think, okay, I need my people on site. They need to be able to come in and touch and feel and see what's going on. And the reality is, in COVID, we've had a lot of customers that have been in the middle of different assessments. Joe, I'm sure your experience has been the same here. People are evaluating internal control frameworks. What do I have around this program in the first place? What are my policies, procedures around development, implementation, and testing, and parallel testing and comparison of new versus existing systems and processes? Those you can do anywhere. You don't need to be on site altogether. We found that many of the engagements that we were in during COVID progressed without missing a beat. People just continued on. The greatest challenge we had was overcoming, the sudden, divorcing of either being on site. Now we were outside of the network, so to speak, and now we had to exchange data between LN network and customer network, and so getting the InfoSec folks involved in understanding, well, how do we exchange large data sets efficiently to enable each other to continue to work effectively? And that was the biggest hurdle for us. Joe, you want to comment on your experience over the last year in that respect?
Yeah, I think it's been very much the same, Chris. I think that, in our business where, in with clients, helping them on their AML and CFT programs, and I don't think, but there was of our team, there was one single individual, and this was a Swiss bank, which has incredibly strict data privacy laws, and that one individual was up and running in a week later, and everyone else on our team was up and running within the day. And I think probably most of the folks on the call experienced that same kind of, we all kind of came from a pre-COVID work from home mentality, and so the transition has been fairly seamless. I would say that whether COVID or non-COVID times, I think that the things to get prepared for as you start thinking about this is, if you're not doing a risk assessment, you really should. If you have a risk assessment that you're periodically doing, is it up to date? Are there changes in your business, your customers, your geographies, your products or services that would create the impetus for you to do another risk assessment? You did, Chris, a nice summary of the model governance and model management. And I think if anyone is looking for more details, exactly as you said, the OCC has this SR 11.7 guidance out there. It's a nice long paper that talks about the expectations across all industries. It's not just specific to AML, but across all of model management. And that's probably the canary in the coal mine from the federal government perspective on expectations. Are you doing regular model validation? Again, if you're not, that's probably something that's coming. So those are the kind of things that I think you've summarized it nicely, Chris. And I think that those are things, regardless of whether you're on site or remote, these are things that can be done via access from home.
And for the benefit of the audience, let me go into some of those control frameworks, because I think I had to kind of think outside the box a little bit on interpreting the model risk management guidance to the internal controls that our most successful customers apply around our kind of screening solutions in this example. But to a large degree, there's a few key things we generally find customers fail to do. Or if they do it, it's done at such a cursory level that it doesn't actually provide the foundation for meaningful and substantive support of production configurations for either transaction monitoring or risk screening for sanctions and PEPs and other things. But the number one thing we tend to see is people don't spend enough time doing their system design assessment. And what do I mean by that? The reality is, and I'll use name screening because it's probably the least straightforward compared to, say, transaction monitoring, because it's more binary. But with screening, you've got a first name, you've got a middle name, you've got a last name, and the empirical assumption is you've got first name and last name data in those fields, right? And there's also an assumption in design that you put first name and last name in the right fields, and inevitably those assumptions don't always find their way into evaluating the data quality. So that's the assumption of the system. That's the requirement I gave the technology, but nobody went back and checked. Is that what's actually in the data file being given to the list screening platform? Nobody did that test. Or if they did it, they picked 10 records out of 10 million and said, yeah, my 10 records out of 10 million, they all had first name and last name in the right fields. But the other 9 million and 900 and some odd thousand, and, do the number, but at the end of the day, 30, 40, 50% of the records actually didn't conform to the data requirements. And I see those first two steps as big weaknesses in the way people implement compliance technology. And again, you have to kind of get into the weeds a little bit. What happens if that's not the case? Or what happens if I put it all in a single name field? Or what happens if it's truncated? What's the assumption there about how it's going to score? And so doing those first two steps are really the biggest fail points I see. And then that translates into the tuning methodology. And there's really around, this is kind of the thing I see most. Customers will call up and say, hey, this isn't catching what I thought it was supposed to catch. And the reality is we get in there and we kind of deconstruct it and we say, okay, it didn't match on this. Well, all right, that's fine. We did a test, and this is the test that we did in model validation, and it didn't catch it. Okay, well, great. Here's the question. In your data quality assessment, did you actually find evidence that this manipulation is happening in your data? So is this circumstance in your testing for model validation actually present in your environment? And inevitably, the response we get is, I don't know, because I never did a data quality assessment. I never evaluated whether or not I conform to the inherent assumptions of the platform or the model or the AI technology. But long story short, they got to the last control item, the model validation testing, and didn't do any of the prior 9. That's the biggest fail point we see in the marketplace in this space. And Joe, I don't know if that's what you guys see as well, but certainly when things hit our support desk and they get funneled up to me, sometimes the more complex ones, that's inevitably, out of hundreds of calls, that's the one that I think all but 2 out of hundreds have actually had some question that we had to go back to our product team and say, hey, what's happening here? Everything else has been an internal control framework weakness on the implementation phase.
Yeah, absolutely. That's very, very common. I mean, I guess the other thing that we see a lot is that there's not an expectation that there would be any change, so therefore the system should be still functioning properly, but there's an upstream system that made changes that impacts your AML monitoring and transaction monitoring system or your sanctions program, and you in the compliance seat was never even aware that change actually created an impact, and there's a silent failure there that's causing you to miss coverage. I guess the only maybe thing that I would maybe add to this that maybe kind of is useful for context is that these programs around model risk management and model validation really are supposed to be fit for purpose. So if you're sitting there listening to this and you have half a person assigned to compliance in your little the small operation, it's a different set of expectations than if you're a large multinational bank that has 50 or 100 different data feeds going into your AML transaction monitoring system. I mean, the robustness of the model validation and model risk management programs that you need to put in place, the questions you have to ask are the same questions, but the amount of effort you need to do to answer those questions is dramatically different.